Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about how to trade breakout markets. Now, what do I mean by a breakout market? When I'm talking about a breakout market, I'm talking about those markets that just don't stop moving, right? They're the ones that just keep going up and up and up and up, or down, but they just don't stop. Those are breakout markets that are really, really aggressive. And we had a great example of that on Twitter today, and a couple other ones actually, that were just monsters. Twitter is a phenomenal example of a breakout market. It broke and it just went pile driving lower. Now, regardless of whether or not this was on news, regardless of whether or not there was some fundamental event or technical event or what, it doesn't matter. It's going down, right? That's the best way to look at it, is it's going down, and that means that we need to be approaching it with that kind of aggression. Now, we have to understand how a lot of the bigger traders are operating, right? We're talking Goldman Sachs and Chase and Citigroup and all of those. Those are the ones that move the markets. And what are they going to be doing when a stock is dropping, this aggressively? Well, they have to be looking at it in the sense of, first of all, where am I going to get in, right? When it drops this aggressively, we opened up, we had a huge bear bar down, buyers try coming in, sellers push it back down, and then it breaks away and just doesn't stop. When do you know it's a breakaway market? Well, I think you had a pretty good clue when this bear bar happened here, but when it followed up with another 3 really strong bear bars down, a 1-candle bounce and continuation lower, that's really late to the party, but it's a good clue that this is still a very bearish market. So where do you get in? There's a lot of different ways to approach this kind of scenario. Now, when you're looking at getting into a stock or a futures market or a crypto, it doesn't matter. When it's breaking away, really the first bounce, right? The first pop, the first correction that happens. Now, how can we define a correction here? Well, a correction isn't just a specific ABC type of thing. You have to look at how the market is moving. And in this case, on Twitter, we have a 1-candle bounce followed up with a really strong bear move lower. We go a little bit further, we have a 1-candle bounce and a strong move further. 1-candle bounce, strong move further. So right now, a pullback in this case would be anything more than 1 candle, really. So if we can get a bull candle or 2 or 3 or maybe a few more, that would give us a clue that this might be the correction. That's where sellers are going to really start pile driving in, and we had that here. We had a bull bar, a secondary bull bar, a bear bar that only triggered in short and never continued, and popped back up again. We are in pullback mode. This is the pullback. Now, inside this pullback, there are any number of different ways to potentially look at trading opportunities. You could look at selling below the first strong bear bar that shows up after the correction has began, which actually would be right there. But another one right here. You could be looking for a bull failure. That would be right here and right here. You could be looking, maybe you're a breakout trader and you want to sell the breakout of the lows. Doesn't really matter. What you're looking for is that corrective phase to begin. Once that corrective phase begins, it's action time. That's where you start trying to formulate your attack plan and how you want to approach the markets, because very likely after that strong of a move down, the market's going to at least make another leg lower. And that's what we're looking for, another leg to the downside. Whether you sold the breakout, whether you sold the bear bar, whether you sold the bull bar, assuming that it was going to fail, doesn't matter. You're looking for your downside objectives from there. Now, again, we have to look at the bigger picture in how the big players, the ones who move the markets, how they're going to be operating this. Now, usually larger funds don't really look at 1-minute charts. They're more focused on longer term time frames, like 5-minute, 15-minute, 30-minute, that kind of thing. So it makes a little more sense to pay attention to those. And if we look over at the 5-minute chart, we can see it's, well, there was, 2 bull bars today? Oh, no, there was a couple more down here. So we have a couple bull bars today, and that's about it. So how are larger sellers going to be approaching this? Well, right out of the gate, first 5-minute bar, massively bearish. There might be sellers that jump in underneath that looking for continuation. It's a bit early, and it is fairly aggressive, but it is breaking down the VWAP. You're breaking back below the moving average. There's a lot of reasons why some traders might take that as an aggressive approach. A lot of other traders might wait for a secondary, a confirmation, and start selling there. Even more, a tertiary confirmation adds even more emphasis to the downside. Once you've hit 3, though, probably not going to be waiting much longer, because aggressive traders who jumped in here, they're already in massively profitable. These traders are doing pretty good. These traders might be a little bit late to the party, but with that strong of a move down, likely going to see a secondary leg. It might only be a second leg that looks like that, but it might end up being a second leg that looks like that. So what sellers will end up doing, if they're really aggressive and have the account size to do so, of course pending their trade plan and the firm that they work for in this case, but they're going to start selling that third candle. They're just going to sell the close of it. This is obviously bearish. In this case, Twitter just announced they deleted, like, what was it, 20-some million accounts for fraudulent or fake accounts. So that, for whatever reason, to me, that would be a good thing because they're fake anyway. But regardless of the reason, the market's falling. It's very aggressive, and it seems to be happening on news. So sellers will sell aggressively the third candle, the second candle, maybe even the first, depending on how aggressive they are. But then we have to start looking at it saying, okay, every bear bar after this is another selling opportunity. So you're not going to go in full bore and drop 100 grand right here. You're going to drop in small little pieces, right? So you're going to piece into a little bit here, sell a little bit more there, sell a little bit more there, sell a little more there, and sell pretty much every bear bar on the way down until it gets a bounce. And again, a bounce, you got to look at the way the market is moving. In this case, the 5-minute chart has a doji, which I can barely call a bounce, or a 2-candle bounce. 2-candle bounce. And continuation. So until we get more than a 2-candle bounce, we're not really in pullback mode. As soon as it reaches pullback mode, that's when market participants are going to look to exit most everything. So let's put this into perspective, right? We have a short right there. There's another sell. There's another sell. There's another one. There's another one. There's another one. You may or may not take that one because it's basically the same price, but for sure another one bounces up. You know, maybe you take off because there's so many already. You've already got 6 positions on. Maybe you take half off, right? But let's just keep it easy. We'll get into the more structured things in a little bit here. We're not in pullback mode yet, so we sell more. Sell more, sell more, sell more. We're not in pullback mode yet, and you're looking for a move back in continuation of the lows. Now, this is an interesting situation that does happen from time to time where your exposure on your account, it's not exposure for risk. You're actually in a really good position, but it's exposure because of how many shares you own now because you just kept adding and adding and adding and adding and adding. It just keeps falling. So this is where a lot of traders will look at it and say, you know what, it's only a 2-candle bounce. It's probably going to go a little bit further, but I have to start lightening my load a little bit or my boss is going to start getting on my back saying, what are you doing with 1 million shares of Twitter? So this is where they're going to start looking at it thinking, okay, I'm going to ease off a little bit. If it starts retesting the lows, maybe taking off half the position, something like that, unless we get a little bit more to this pullback, right? So they'll take off half the position and look to exit everything at the lows and take off, 80% at the lows, something like that, hold on to a remaining 20%. Think of how much that would be worth, right? You have your entry short there, there, and I'm drawing them all down to the target of the lows. All right there. My lines are obviously not very straight. Right here, right there, and break even, right? That's a ridiculous amount of profitability to the downside that they're able to lock in. And if they're taking 50 to 80% of their position off on a retest of the lows, now they've got more money to play with. And guess what? We haven't entered pullback mode yet because it hasn't gone more than 2 candles based on what the market has told us so far. So now that they've liquidated a good 50%, they have a huge stack of cash sitting in their pocket. Now they're going to start looking to add more. So the next bear bar, sell more, sell more, sell more. And they're going to keep doing that until they get a correction. Now you can see this actually taking place on the 1-minute chart a little bit more clearly. It's a 1-minute chart, so you'd have to have a lot of positions on the table. We have that really strong breakaway. You have the breakdown that we were looking at on the 5-minute chart, and by the time the 5-minute chart kicked in, it was right around, kind of this area here. This is where that doji happened. So you have sellers that are selling all the way down, and you finally get a pullback mode. They exit, 50 to 80% of the position at the lows, and they start doing it all over again. Exact same situation. So again, it doesn't matter necessarily if you're looking at why the market's doing what it's doing or how it's moving. It doesn't really matter what you and I are doing because we're not trading the billion-dollar accounts at Goldman Sachs. So we need to pay attention to what the traders are doing who are actually moving these markets, and that's the type of mentality that they're going to be approaching this with. Now, could someone do this that doesn't necessarily? Of course you could. You don't have to work at a bank to be able to trade like that. You just have to trade a little bit smaller. You can't jump in with 20,000 shares at each price. But that's the mentality. And that's why the market keeps falling, because it's in a breakout mode, because everybody's short. The buyers who are trying to buy this are perpetually getting stopped out over and over and over again, the bottom pickers. Well, you know what they say, when you try to pick a bottom, you usually get a handful of... Yeah, well, that is a great example of Twitter today. They got a handful of S because it just collapsed on top of them when they were trying to pick the bottom. Not necessarily the approach that you want to do. Another great example of this was on Caterpillar today. CAT. Look at this thing. I mean, it's just a monster to the upside. And this one's actually entering pullback territory now. Exact same situation, just inverted to Twitter, right? Look at this monstrous rip to the upside. Buyers are going to be all over this, buying everything they can get their hands on. Now, this is a unique situation because this is to the long side. And the long side means that it's something you can hold indefinitely. Now, you could hold a short indefinitely, but the profitability is capped at it going to zero. The long-term investors or people who are trying to build a portfolio are going to be interested in this a lot more because not only is it a monster ripper, I mean, it's going up really aggressively, but they also have an opportunity to scale out and hold a position while banking profit and adding to their long-term portfolio. It's a beautiful split when this kind of thing happens. So you'll have buyers that are coming in and they're looking at it saying, okay, well, you know, this is a little bit more of an expensive stock. So let's just use easy numbers. We'll use round numbers of 100 or 1,000. You see this really strong breakout move, you buy 1,000 shares. Buy 1,000 shares, buy 1,000 shares, buy 1,000 shares. You get the idea. You're buying all the way up, right? 1,000 shares on all of these moves up. You start getting into that situation where you are now in a position where the exposure on the account is very high, likely, because you're buying so many shares, you're holding so many shares that you might need to start looking to exit some, right? So a lot of traders will look at this and say, okay, well, the next time it makes a new high, I'm going to exit 50 to 80% of my position. I'm going to hold on to that little bit left to see if it wants to keep going for the rest of the day. So when it goes back up to the highs, you're probably going to find resistance initially here. But once it breaks out above those highs, you're probably going to see more continuation up. Now, again, going back to the long-term investor side of things, this is where it gets interesting because they're able to go in and say, okay, well, I'm going to be buying, you know, we'll use smaller numbers because it is a more expensive one, 100 shares at each one of these prices, right? You're buying 100 shares, 100 shares, 100 shares, 100 shares, all the way up, and it goes back up to the highs. You exit out of all of these. It'd be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Oh, perfect. You've got 1,000 shares long. Couldn't have done that one any better. So you have 1,000 shares long. You're up on average, you know, your average price between all of them, probably around 139. So you're up about a point on 1,000 shares once it goes back up to the highs. That's a good payday. So what you're going to be looking to do is exiting 80% of it. So you exit 80% at the highs. You are now holding 200 shares left. Well, let's say you want to add some of that to your long-term portfolio. So 50% of that goes over to a long-term hold. You ignore it, right? You add it to your long-term position. Maybe you like the dividend of Caterpillar or whatever. You just want to hold on to 100 shares of it. That's fine, and you'll be able to do that because you've banked 80% of the profit. You've pocketed a boatload of cash. The shares that you're holding on to are basically free at that point, and now you can hang on to another 100 shares that you can utilize to trade with, 100 shares that you're adding to your long-term portfolio, and those extra 100 shares might very well make you another couple $1,000s if it just keeps going. You never know. So it's a really interesting scenario when you run into these breakout markets because it offers up a possibility that, like we were just talking about, you can buy into it, you can buy more, buy more, buy more as it's going in your favor, adding to winners. And you get to an area where you want to take some profit. You take some profit off the table, you bank a little bit on the side for a long-term portfolio, and you still have a little bit left that you can play with for, you know, maybe covering a really nice dinner this weekend after a long holiday. Regardless of the way that you approach it, though, that is the mentality that a lot of traders are going to be looking at when you have a situation like this. Something to keep in mind. You may not be able to trade that way, you may not be comfortable trading that way, but that is a way, one of the ways out of several, that a lot of the larger funds are going to be pushing these kinds of markets, and it's something you got to keep in mind. So that's going to do it for this one. Hopefully you found it interesting, useful, maybe something you can add to your tool belt, or at least keep an eye on. Aside from that, as always, if you have any questions, make sure to send me an email, jbrink@slingshotfutures.com. Underneath the video, make sure to click on the subscribe and the notification bell icon so you see all the new videos that we come out with. We usually come out with 1 or 2 videos every day, except for Fridays, so make sure to stay tuned for those. But aside from that, enjoy, rest up, and we'll see you all in the next one.